Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today we're going to look at a paper trade in the S&P 500 index. We'll discuss should we pass or should we play. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. In the title today, we use the word befuddling. And I think that's where the marketplace is at right now. Definitely the bad news is worse than the good news, and the marketplace is taking it really hard. But I think the biggest issue in the marketplace is the geopolitical concerns. The conflict between Ukraine and Russia is driving up food costs around the world. Who knew that Ukraine was one of the biggest suppliers of wheat to the rest of the world? And not to mention the fact that we pray and have all the concerns for all the Ukrainians and everything that's happening to them in that space. So that has driven the markets. Inflation is going higher. Has to do a little bit about what the money that we spent during the pandemic. We have supply chain concerns, and the Fed wants to raise interest rates. And they've been very transparent as to what their plans are going into the end of the year. The Fed came out and basically said, yes, everything that we said 3 months ago is what we're doing now. And the market took that as a positive, and we had a big spike up. The very next day, we gave it back and then some. So there's been a line in the sand that a lot of analysts have talked about, because as far as the marketplace is concerned, we still have had fairly decent earnings this earnings season from a lot of the companies. There's been a lot of supply chain constraints, and that's been the biggest concerns from most of the CEOs. Peloton came out today and said that they do have some cash issues, and that drove that stock about 15% lower as of right now. And now, when I look at the market, one of the things, and this is probably the most befuddling thing to me, and I've been talking about it for weeks and weeks, is that the VIX index, and I'm going to show the VIX watch list right now, just doesn't really show a ton of concern considering what is going on in the marketplace. So we see the VIX right now at 33.96. We have the market up today just a fraction, and we have the VIX down about 90 cents. Now, the market's been all over the place, opened up, now back down. And one of the things that I even highlighted all the way back here, and I'm going to go all the way back to April where I'm pointing on the chart, when the VIX was hanging out around the 20 level, and actually let me add some moving averages in here, okay? When the VIX was hanging out down around the 20 level, we see the 200-day moving average. In my mind, if we're below that 200-day moving average, I would actually consider that low volatility. Now, in the past, anything around 20% would be considered high volatility, and I'm talking about pre-pandemic stages. But the fact that we were trading around 18 or 19% implied volatility with everything that was going on, I had mentioned many times that I was very confused that people weren't willing to pay up for protection, and that's really what drives the index higher. That's why they call it the fear index. If you look at a chain in the S&P 500 index, the main index that gets quoted probably in all the financial networks, you will see that more put options are always traded than call options. 99% of the time, you're going to see more open interest on the put side of things, no matter what type of marketplace that you're in. And that's mainly because a lot of the big institutions like to use the S&P 500 index as a hedge. So they're buying puts as protection, not necessarily to be bearish, but to protect their portfolios against downward movements in the marketplace. Ideally, when you buy a protective put on a portfolio using the S&P 500 index, you still want the market to go up. right? Because you still own the portfolio of stocks. Hence the name, the fear index, and the VIX was just below the 200-day moving average. In other words, in a period of kind of low volatility. Now, if you come up and you see now we blew through that and we went up to the 30 level and we hung out there, and I still felt the marketplace had down day after down day after down day, and you're still kind of like, why aren't we seeing a higher VIX index? If I zoom out on my screen here, I'm going to highlight that 40 range that I've talked about more than once. Since the pandemic, we've touched it twice. And to see this movement to the downside without that big spike up in the VIX just kind of, to me, doesn't, well, the VIX by itself isn't an indicator. It's just a one-off number. But when you see big down days after big down days after big down days, and you still don't see people rushing to the marketplace to try to panic buy insurance, to me, it's not a sign of capitulation on the downturn yet. And we're still not there. And I want to walk you through my process of this week's topic to look at the S&P 500 index. If I look at the chart, I'm going to run back up to the chart tab here, and let me scroll down a little bit of the S&P 500 index. I was really hoping yesterday, everybody's been talking about, and I'm going to highlight it here, the 4,000 level. And if I move my crosshairs all the way over, you kind of see there's a lot of noise. This was a breakout area. Nice big round numbers in these big indexes that get quoted all the time. Seem to be a place of support and resistance in the marketplace. Right here, it took us a while to break out of that level. Never came back once we did, all the way back up. And guess what? We're all the way back to that level right now. And we're off 20% from the highs. A lot of people said the 4,000 level is something that we could target. Now, I think on a couple of shows back, I do quite a few podcasts every day. I'm not sure if we talked about it on the stock play of the day, but talked about the market coming down to the 4,000 level and the VIX spiking up to the 40% range or even a little bit higher. To me, that would be a sign of capitulation in the market. Everybody's trying to guess where the bottom may be, but we just went straight through it. And then today, we had a bump up in the market. Now it looks like we're even, we're flat. The market just is befuddling. It can't decide where it wants to go next. So yesterday I was thinking, well, maybe if we do get that bounce at that 4,000 level and we don't close below it, which we ended up closing below it, maybe it's time to get long an out of the money SPY call and go out, to the end of the summer and just buy a little bit of premium as a FOMO trade, not as opposed to the opposite where on Chevron, we looked at some of the energy companies and those actually aren't doing as well either. Chevron had a real nice pop up after we talked about it on the stock play of the day. So if we're looking at this position, maybe we buy an SPY call, a little bit out of the money, just to dip our toe in the water. We've had some cash on the sidelines. We want to try to pick the bottom. That would be one way that I would consider doing it. But it didn't happen. It didn't happen. As a matter of fact, right now where the market is at, I would actually like to look at more of a long straddle in the marketplace where you buy, or even a strangle, you buy a longer term out of the money call and a longer term out of the money put. Because the VIX being at 34, I don't think it's an expensive volatility relative to all the news and all the concerns that are going on in the marketplace. So at this point in time, not really sure where the market's going to go. And I don't think, obviously, you never really know where the market's going to go, but befuddling. It's befuddling to me that we're at these levels, that we haven't bounced, that we haven't seen the VIX get to the 40 level, that the 4,000 mark didn't even hold, not even for a second. We closed below it. And, oh well, okay, so we're going to do an advanced trade. And I'm mainly going to talk about this because when I do see the VIX in the higher range, and it's definitely high volatility, I'm not going to belabor that point. We're at 33% in the VIX right now. So when that happens in the S&P 500 index options, trades like more advanced trades like long call spreads where we're buying one, selling one, butterflies, they are more interesting to me because you have a 4,000 point index. You also have higher volatility. And in the S&P 500 index, I want to take this opportunity to let you know that they're actually going to have an expiration that they're going to have an option contract that expires every single day of the week. Monday, Tuesday, Wednesday, Thursday, Friday. The chains are very confusing because there are so many different expiration dates, but the Chicago Board Option Exchange has decided that they're going to have an expiration every single day of the week in the S&P 500 index. Just that simple, that straightforward. That was their goal, and they've gotten there. The Thursday expiration, I don't think has came out yet. There's a specific date when they're going to release it, but they did do the Tuesday expiration, and I don't have that date handy. I probably should have figured that out before we started our call. All right, so let's get into the trade because we have a lot to talk about on this trade. It's going to be a fairly straightforward trade to discuss today, but we are also going to talk about an adjustment to that trade. We're only going to do a 3-day trade because I don't even want to go out longer than 3 days. No idea where the marketplace is going to be at the end of the week. And I'm going to look at an adjustment. That adjustment would normally be done on Wednesday or Thursday. Our stock play of the day overtime is on Friday, but the adjustment would be rolling it into a butterfly. And I'll talk a little bit about that. But because vols are high, the two trades, the butterfly and the long call spread, which is going to be the paper trade today, are going to be fairly cheap. And it has everything to do with the VIX being up around the 33% level. Okay, so I'm going to run on over to the Ally Invest option chains. And before I do that, this is a fairly advanced topic. So if you have any questions, please put them in the chat box. I'm going to try to address them at the end of the show. We love to do these live, and we mainly do them live because we want to make it an interactive show. We want you to participate. We want you to share this with your friends and family and let them know that, hey, we're doing good things here over here on the stock play of the day. Okay, so let's show the Ally Invest option chains. We see right now, well, the market at the very beginning of this call, the market was flat as we talked about in the VIX. Now we're down 7. We're trading at 39.83. Okay, we're going to look at a long call spread, but we're going to sell the more at the money option contract and sell a lot of time premium in that contract. So if I scroll down and I look at the 3-day expiration, I'm going to highlight all the different expirations that we have available in the option chains. Just to show you, we have a May 16th, May 17th, May 18th, May 20th, all these different expirations. As a matter of fact, there's 2 different expirations that are May 20th. So the S&P 500 index, the chain is very confusing because of that. But we're highlighting that this one is actually a weekly. This would be a normal monthly expiration. So you want to make sure, and I'm just going to give you this caveat, is if you're trading in the SPX, you want to understand what the chain says. And if you got to do a little bit of research, feel free. Okay, the options we're going to use expire on Friday after the close. So these option contracts will trade all day Friday, and then there would be a settlement value in the S&P 500 index that would get determined on the close on that Friday based off of basically wherever the index closed at. Okay. So in this trade, we're going to do a very short-term trade, and we're going to go 10 points out. So we're going to, the market's at 39.80, well, 82, it's moving, it's definitely moving. And we have an at-the-money option contract trading at 40% implied volatility. Now, I mentioned the 40% number on the VIX, that's a 30-day option. But we're seeing that the short-term options are reflecting a lot more volatility than a little bit longer-term options. And I do think that that has something to do with, obviously, what's going on in the marketplace, and especially this 4,000 level. All right, so I really like the market to just stop for a second, but it's not going to, is it? All right, so we're going to sell the most at the money option contract. So in this instance, we're going to be looking to sell the 39.80. Yep, market's right there. Okay, so I'm watching the market right here. And we're going to buy 10 points in the money, and we're going to buy the 39.70. Okay, so here's one of the things that makes this interesting. Okay, because of the way the SPX is, and the fact that honestly that there's a lot of skewing towards the puts because a lot of people like to buy SPX options as protection, including institutions. If you're buying an in the money option and selling an at the money option contract, you shouldn't be able to get it done with a 50-50 ratio, right? So right now, 77. Right now, it's actually gone up a little bit. Stay right there, right about $5. We're going to call it $5 bucks. Okay, we're going to put it in the right rail before it moves, and never guarantee a midpoint fill. But this is the risk reward that I'm shooting for. We have a 10-point wide trade. The market is basically trading very close to the 39.80 level, meaning that the trade is already at the maximum, right? Above 39.80, we can't participate anymore in the upside, but we're doing a 10-point wide trade for $5. It means we're risking $5 to make $5, and the market just needs to stay where it's at. It doesn't need to go down, it just needs to stay in that range. That simple, that straightforward. All right. So we're looking at a net debit of $5 for the account, and this is going to be the official paper trade. Now the market has moved down to the 39.75. All right, we should see this starting to drop a little bit. All right, I'm gonna roll with it. Okay, so we're buying to open the 39.70 SPX May 13th, this Friday expiration. Selling to open the May 13th 39.80 expiration. We're hoping to get it done for a net debit of $5. I would expect that to go down a little bit if the market keeps going down. We're seeing it flashing. The market's moving very, very quick. And our goal here is that the market stays above 39.80 by that expiration date, by this Friday, and we get a little bit of a pop back up to the 4,000 level. Now, I thought about doing this trade in reverse, about being bearish on the market and looking at doing a butterfly. That's part of the reason why I put befuddling in the title this week, because that's really where I think the market is at. I really don't know where we want to go next. Sometimes the best solution is to just lay down until the urge goes away and not put a trade on, but that's not what the stock play of the day is all about. We want to talk about a potential trade, and this is one that I feel comfortable with because we're managing our risk. We're risking $5 or $500 for every 1-by-1 spread that we do to try to make $500 on the upside. And we got to put commissions in. As always, this is not meant to be a recommendation, especially in markets like this. This is we're just looking to do this on paper and learn about the trade. And the biggest thing here is to realize that when you have high volatility, you have an index like the S&P 500 index where you see a lot of put volume, you see a lot of people coming in to buy out of the money puts for protection. Sometimes you can get a trade done with a nice risk reward scenario based off of where the marketplace is at. And that's what we're highlighting here today on the stock play of the day. So I'd really like to do this. The markets came all the way back down. I would really like to do this where this is an at the money option contract, and that's the one I want to sell. Then I want to go a little bit further out of the money. I want to keep it 10 points wide. If the market continues on down, I'm going to leg this into a butterfly. And I'm going to show you that on the stock play of the day overtime on Friday. We'll walk through the scenario on Friday, even no matter where the market goes, because it's a interesting trade to do in the indexes, and it's an interesting way to hedge a trade. I never want to do more than one hedge on any one specific trade. I guess maybe if I was out 100 days in time, I may adjust it twice. Most of the time, I don't want to overtrade that position. And a little bit fairly advanced trade that we're looking to do here on this stock play of the day. Okay, now I'm going to run to the questions. Hopefully we have a few questions out there. And if we don't, that's okay. We've got a few people out there. I appreciate the thumbs up. Please give us a thumbs up. Please share this event with all your friends and families. And if you have any questions, please put them in the chat box and I will try to address them. If not, want to show you what the legging into the trade would be, since we don't have any questions in the chat box. Let me highlight that a little bit. I'm going to go back to the chains. Now, this is what the legging in of the trade would be. We would actually come back in. The market went down another 10 or 12 points. I would want to sell the 39.80 and buy the 39.90. Keeping this a 20-point wide butterfly, bringing in a net credit to the account, and then you would have a 1 by 2 by 1 butterfly, a standard butterfly. And I want to do that if I can bring in a decent credit to the account, meaning that if the market goes against me, I still want to be able to bring in a net credit of $2 or $3. And then you're just kind of hoping that the market would come back and land somewhere within that 20-point range of your butterfly. And to me, that trade is, I don't want the cheese anymore, just let me out of the trap. It lets you haven't exited your position, but you still got a chip in a chair. You still got a chance that the market could come back. And we're just talking about very short-term moves because we're only going to go out till Friday on this trade. All right. Let me see. One last check for questions, and I do see a few in here. Okay. SPY versus SPX. Great question. As a matter of fact, I meant to adjust that. That's for Murray. Yeah, you can. The SPY is a tenth of the value. So one of the things about the SPX, one of the benefits of it, there are detriments too, but one of the benefits is you're doing a short-term trade. There are some tax advantages to trading indexes. You want to Google the 60-40 rule. If you, we can't talk about taxes on here, but you need to know a little bit about that. Some of the, if you're doing the SPY, well, in theory, you could do 10 contracts, and that would be equivalent to doing one contract in the SPX, right? But if you're just doing it on paper, you're just dipping your toe in your water and you want to do it fairly cheap, the SPY would be an alternative, and you could just do a 1 by 1 long call spread in the SPY. All right. Okay, I'm new to investing, but holding crypto for a year. Have a money market account, 401k, hold a couple of small ETFs. What's my next move in this climate? Jacob, the next befuddling. That's what the theme was today. If you hold some ETFs, Lindsay Bell, our chief market strategist, actually wrote a good article this week. She puts one out every week, but this week really addressed the concerns of the marketplace and what to be thinking about, and basically your long-term goals. I think when you're seeing a rise in interest rates, it usually means the economy is doing well, and longer term, you'll usually see the markets bounce back. Now, I'm using obviously a lot of trepidatious words here. So it's tough to just buy and hold, but usually in these types of periods, the market will eventually bounce back. Now, the 4,000 level was a scary level that we broke through on the downside. It would be really nice to see us finish above that. It's part of the reason why we picked the trade that we did today. But without knowing your situation, some people might look at this as a buying opportunity to try to buy low, and then hopefully the market bounces back and you can sell high. So there's no great answers, Jacob, to this question right now, except for it's hard to just buy and hold, but don't panic. Sometimes it helps to not get quotes in the marketplace. All right, and Jacob's got another one. The Ally Robo-Advisor portfolios. trying to buy a home at some point. Thanks in advance. Love these streams, so thanks for doing them. All right, and if you're looking to buy a home, well, that means you have maybe a little bit of a shorter term look, and this is a tough marketplace for that. The only good news as far as home buyers are concerned is that demand is waning and prices should come down, but interest rates, the 30-year mortgage is 5.5, pushing maybe 6% by the end of the year, which a few years ago that was down around 3%. So you're getting, odds are that housing prices are coming in, but interest rates are going to make them basically the same cost. All right. And Clinton says, thank you, Brian. Well, I appreciate that. I appreciate a lot of the love we get here on the Stock Play of the Day. So click subscribe, ring the bell. Please share with everyone. We would like to drive some demand. We want it to be an open forum. We want your questions. We want to be able to talk to them and address them. All right. Thanks for coming. See you this Friday for the Stock Play of the Day, overtime.